Hey there, grab a seat for a second. Let's talk. I want to completely rewire how you look at the stock market today. Honestly, think of me as your thoughtful older brother here, trying to save you from making the exact same painful, expensive mistakes that I've seen countless others make. If you can grasp this one foundational concept we're going over today, everything else in your financial journey gets, well, infinitely easier. Okay, let's dive into this, because in today's explainer, we are laying the absolute groundwork for true long-term wealth creation. So let me ask you a question. Imagine you own a little corner grocery shop nearby. It's a fantastic little business, right? It makes about 5 lakh rupees in profit every single year. And you know for an absolute fact that in 10 years, it's going to expand and make 50 lakh in profit annually. Now, if someone walked in today and offered you 40 lakh for the whole shebang, a little less than it's worth right now, would you panic and sell it? No way. You'd be crazy to let it go. You'd literally laugh them out of the shop. But here's the wild thing. That same person who would laugh at the grocery store offer, they'll watch their HDFC Bank shares drop 5% on some random Tuesday, and they will completely panic and hit the sell button. They make the exact same mistake. Why? Simply because they've forgotten what they actually own. You see, most retail investors look at the stock market and they just see a ticker. They see TCS 4,150 rupees. And that's it. To them, it's just a blinking number, a symbol. Just a piece of paper that goes up and down. They're constantly agonizing, asking, when should I buy? When do I sell? Which one is cheap today? But what is a share really? It is a small slice of a real running company. When you buy one single share of TCS at 4,000 rupees, you technically become an owner of a small piece of that enterprise. There's 6 lakh employees, their 2.4 lakh core revenue, their massive global clients like Microsoft and Google. You own a fraction of all of it. Stock equals company, period. So the crucial point is perfectly captured in this brilliant quote from Warren Buffett. I don't buy stocks, I buy businesses. I know, it sounds like just a tiny difference in vocabulary, but my friends, it contains the entirety of investing wisdom. If you can make this single mental shift, treating every stock purchase exactly like buying a tangible brick-and-mortar business right in your neighborhood, you instantly separate yourself from the gamblers. You stop treating the market like a lottery ticket, and you start thinking like an actual owner. Now, to really understand how the market evaluates these businesses over time, we have to look at Benjamin Graham. He was actually Warren Buffett's guru, the true father of value investing. And he gave us this absolute timeless rule, which goes like this. In the short run, the market is a voting machine. In the long run, it is a weighing machine. This concept right here, this is exactly how you survive the market's craziness. Let's break that down a bit because it is absolutely crucial. In the short term, meaning days, weeks, or even months, the share price is just a voting machine. It runs purely on human emotions. We're talking news, panic, FOMO, hype. Think about the Yes Bank crash, or that massive wave of panic during the start of COVID. Those are short-term emotional moves. It's just about who likes what today. But the weighing machine? Over 5, 10, or 20 years, the only thing that actually matters is the company's real performance. Are the profits growing? Are revenues up? That is the real weight. If the business is getting heavier with profits, the share price will eventually, inevitably, grow. If you get stuck watching that daily voting machine, you will drive yourself completely crazy. You have to focus on the weight. Okay, let's move forward and see how this builds into actual life-changing money. Because when you hold on to these heavy, fundamentally sound businesses, how do you actually make the money? Well, there are exactly 3 ways. First up is capital appreciation. That's when the company's profits grow, its valuation increases, and the share you bought at 100 rupees simply becomes 300. Second is dividends. If the company is highly profitable and cash-rich, it literally distributes a portion of that profit straight into your bank account every year. You do absolutely nothing, and the money just arrives. And third, the most powerful force of all, compounding. This is where you reinvest those dividends over 20 or 30 years. It creates this massive snowball effect. In fact, Warren Buffett made 99% of his immense wealth after the age of 50 simply because of the sheer, unstoppable math of compounding. Let's look at a really concrete example of that capital appreciation. If you look at TCS, their 2004 IPO was priced at 850 rupees. But after adjusting for stock splits and bonuses over the years, your effective entry price was actually around 100 rupees. Today, that price is over 4,000 rupees. That means your initial investment multiplied 40 times in 20 years. And listen, this wasn't because of some magic trick, and it certainly wasn't gambling. It happened simply because the underlying business continuously expanded its operations and massively grew its real-world profits over 2 decades. Now, what's really interesting about all this data is how it grounds this theory straight into the reality of the Indian markets. Just look at these staggering numbers. HDFC Bank, going from a listing price of around 40 rupees back in 1995 to over 1,700 rupees today. Asian Paints, from 40 rupees in 2000 to roughly 3,000. Pidilite, you know the company that makes Fevicol, from 50 rupees in 2005 to over 3,000. And Nestle India, the makers of Maggi, climbing from 2,000 to over 25,000. Plus, remember, they were paying out solid dividends every single year along that entire journey. And this brilliantly illustrates just how massive those wealth multipliers truly are. I mean, these represent generation-changing wealth. We're looking at 75x for Asian Paints in 24 years, 60x for Pidilite, 42x for HDFC Bank. But I want to pause here for a second and, as your older brother, give you a harsh reality check. 99% of retail investors absolutely did not make these returns. Why? Because somewhere along that wild 20-year journey, the markets dipped, the shares fell, they panicked, and they sold. Real life-changing wealth is only made by those who buy these giants and stubbornly hold on to them. So to prevent yourself from that kind of panic selling, you need strict rules. Legendary Wall Street fund manager Peter Lynch gave us one of the best rules ever right here. Know what you own and know why you own it. It sounds incredibly simple, right? But before you buy a single share, you must be able to answer some very basic questions. What does the company actually do? How does it make its money? Who are its biggest competitors? And what is going to happen to this entire industry in the next 10 years? Honestly, if you can't answer those questions off the top of your head, do not buy the share. Lynch famously pushed this concept even further. He said you shouldn't invest in any idea that you can't illustrate with a crayon to a child. Seriously, grab a crayon, and if you can't explain the business model simply, you don't really understand it. Take Asian Paints, for example. It is so incredibly easy to explain. They make paint for the walls of your home. They have a massive, unmatched distribution network of over 70,000 dealers across India. It's a simple, dominant business that Indian families have trusted and used for 30 years. Because you understand that simple fact, when the stock market dips, you don't panic. You know the underlying business is still rock solid. And that brings us to the ultimate filter, the one thing that will save you from jumping into bad ideas. It's Warren Buffett's 10-year test. If you don't feel comfortable owning a stock for 10 years, you shouldn't own it for 10 minutes. Think about how drastic that difference is for a second. 10 years versus 10 minutes. Every single time you get a hot stock tip from a friend or you're tempted to chase the latest market fad, I want you to run it through this filter. Ask yourself, will this company still be alive 10 years from now? And crucially, will it be making more money then than it is today? Let's actually apply this test practically right now. Look at HDFC Bank. Alive in 10 years? Yes, absolutely. Making more money? Probably yes. Okay, now look at Coal India. Alive in 10 years? Maybe. Making more money? Highly doubtful, especially given the global shift to renewable energy. Now look at the latest fancy, cash-burning tech startup making headlines. Alive in 10 years? Honestly, who knows? If your answer to the test is who knows, you skip it, walk away. This test is your shield. It saves you from chasing those so-called next 10x stock tips that almost always end in tears. Because here's the secret. When you filter out the junk, when you buy real, solid businesses that you actually understand and you hold on to them for dear life, the math just takes over. Let me give you one final mic drop moment to put this into perspective. If you had put just 1 lakh rupees into Nestle India back in 2005 and simply resisted the urge to panic sell during every single global crisis since then, that single investment would be worth over 12 lakh rupees today. 12 times your money. And how did you do it? Just by sitting on your hands and letting the actual business work for you. So here is my final challenge to you. I want you to truly commit to this foundational mindset moving forward. We are not trading, we are investing. This is not speculation, it is ownership. The goal of all the financial analyses we will ever do on the show is simply to identify good companies at the right prices and hold them for a very, very long time. Because when you stop gambling on ticker symbols and start acting like an owner of actual businesses, everything changes. So the real question is, are you ready to stop trading and start truly owning?